Today we are focusing on Bill Gates' portfolio. We're going to focus our analysis on some of the dividend paying companies that he holds, and as always we're going to look at the historical performance of these companies, how well they've done. We're going to jump into their financial metrics, looking at their dividend safety, and as always we will run them through our valuation model, getting to our intrinsic value and our acceptable buy price given our investor margin of safety. Now, the first company that we are looking at, which is his biggest holding, is Microsoft Corporation. This is one that has been on a phenomenal run this year, up 57%, even though it excludes those dividends. What a run it has been, right there towards the 52-week high. It does offer a yield, although very tiny, at 0.8%, and if this is one you have been holding in your portfolio over the last 10 years, you would be up around 919% excluding dividends. Absolutely incredible. So let's take a quick look at some of those metrics. Dividend safety score 99, the safest obtainable. 2.8 trillion mega cap company. And when we focus on some recessionary metrics, well, last recession they maintained the dividend around average growth during that period, and we can see they very slightly beat the S&P 500 with a negative 48% return versus the S&P's negative 55. Now, dividend growth, very consistent, double-digit increases, 10% increase this year, 10% increase on average over the last 5 years, double digits, 19% over the last 20 years. Absolutely incredible. If you've been holding Microsoft over the last 20 years, every year on average those dividends would be up 19%. Now we can see as well they have been increasing those dividends for the last 13 years. Now, when we look at dividend yield theory, it states that the company is undervalued when the current yield sits above the 5-year average, so we have a sign here of overvaluation, but bear in mind we don't look at any of these models in isolation, and we'll draw our conclusions towards the end. Forward PE, well, 33.5 above the 5-year average at 29.8, another potential sign of overvaluation, and we can see the current PE well above that sector for information technology at 24.8. As always, when we look at the payout ratios, we do tend to focus on the free cash flow payout, as earnings is susceptible to manipulation by management through accounting. My personal preference is below 60%, gives me faith that management are able to offer those increases double digits year on year that we love as investors. And as we can see, for the last 10 years, it's been well below 60%. In fact, over the last few years, it's even been below 40%. 2023 came in at 34%, with 2024 expecting to be roughly the same, so we should be expecting a nice double-digit increase to those dividends. Free cash flow per share, well, very positive, $3.26 in 2014, $8 in 2023, expected to go just below $9 in 2024. It isn't massively consistent. We do see some years where it's flat, but we do see overall on the long period it is increasing, which is great to see as a long-term investor. Sales growth, double-digit increase to the top line for the majority of the last 10 years. 2023 did come in at 7%, which was slightly disappointing given how the last 5 years had been. But again, this is a company that does tend to innovate. It does have a lot of different revenue streams, and we would expect those double-digit increases to the top line to return in the foreseeable future. Numerically speaking then, for those that like to see the numbers, 87 billion in 2014, 212 billion in 2023. Now, if that wasn't enough, what they also do is return excess cash to investor pockets by doing share buybacks. 8.4 billion in 2014, 7.47 billion in 2023. Always positive to see. ROIC, as always, we look for 10% or more, gives us faith that management are able to effectively allocate their capital. And as we can see, double digits every single year, 31% in 2023, gives us faith that management are able to operate this company effectively. Operating margin, free cash flow margin, not a lot to say other than the fact they are consistently and considerably above the minimums we look for on both margins. So if you didn't know already, this is an absolutely fantastic company. And another sign of that is when we look at the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. It does show us 2 points: 1, the balance sheet strength, and 2, that dividend safety. And in theory, these numbers show us the number of years it would take the company to pay off all of their debt net of cash on hand, showing that for Microsoft, it wouldn't even take them 1 day to pay all of this off. So absolutely phenomenal. Now let's jump into the valuation for Microsoft. And if you're a regular viewer, you do know that we tend to run through every single one of these models when we do in-depth analysis. But for today's episode, we'll jump straight to this intrinsic value calculation. And as always, it is just the average of these models that we are taking a look at. So for Microsoft, we get to $391 as the intrinsic value. Current price sitting at $375. Margin of safety then, typically we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. A lot of investors will look at Microsoft given the quality of the company, the absolutely strength of a balance sheet with a very high score rated, only as high as Johnson & Johnson. These two are companies that have a AAA graded balance sheet. And at 10%, a lot of people may look to buy this at around 5%, depending on the investor and their thesis. At 5%, it is a few dollars shy of the current trading price, so you could argue Microsoft right now is offering around a 5% margin of safety. Now, what do essentially the institutions, what do Wall Street say? Well, we can see they forecast the price over the next 12 months to $423, so they do see around 15 to 20% upside. So in conclusion, for Microsoft right now, we see it at around a 5% margin of safety, with Wall Street seeing around 10 to 20% upside over the next 12 months. We then move on to the second highest dividend paying company within Bill Gates' portfolio. Now, the second one, just due to the amount in his portfolio, is Berkshire Hathaway, BRK.B, but given it isn't a dividend-paying company, we will skip this one and jump into Canadian National Rail. If BRK.B is one you want to analyze, we have recently gone through this on the channel, so do check that out. So the second company, we have Canadian National Railway Company. It is one that I have been buying this year. It is one I also hold in my own portfolio. Year to date, up around 5%, significantly lagging the S&P 500, which is up around 25%. We do see it towards the 52-week high, and it does offer a yield of 1.86%. Now, over the last 10 years, if you've been holding on to this, you would be up around 121%. So let's look into the numbers. Dividend safety score, another one with a very safe score. 81 billion market cap, a large cap company. Now let's look at those recessionary metrics. Increased in the last recession the dividend, average growth in terms of sales, and also outperformed the S&P with a negative 45% return versus the S&P's negative 55%. Dividend growth, nice to see above inflation increase at 7.8% versus 4%, which is the average inflation in the US over the last 40 years. One that I do advocate on the channel to always get more than year on year. Last 5 years, double digits, very positive to see. Last 20 years, double digits at 16%. It is what we love as dividend growth investors. And we can see they are a dividend aristocrat, having increased those dividends consecutively over the last 25 years or more. Now, dividend yield theory, we can see here a sign of reasonable valuation with the current yield in line with the 5-year average. Likewise, forward PE not too far off the 5-year average at 21.5 versus 20.5. If you want to compare it to the industrials, well, the sector PE is slightly lower at 19.8. Now let's get into the payout ratio. What do we see in terms of that? And as always, below 60% is what we target. Other than 2019, where it did slip up higher, we can see it has been below 60%. 2022 at 51%, 2023 expected 56%, so we should again expect 2024 to have a nice increase, hopefully double digits that we'd like to see. Free cash flow per share, we can note that it is increasing, 187 in 2013, 571 in 2022. Not very consistent though, as we can see, it did start to increase to 2017 before decreasing back-to-back years and then picking up. So always understand the type of company you are investing in, whether it's a fast-growing company, whether it's a company that is more mature and doesn't tend to increase as the likes of the tech companies. Sales growth, pretty mixed. We do see 2 years of negative growth, but overall it does at least keep in line with that rate that we look for steady moderate growth at 3 to 7%. And when we do come to look at this, numerically we do see it has increased by around 70% over the last 10 years. 10.6 billion in 2013, 17 billion in 2022. Now, one of the things that I love about this company, the reason why it is one that I hold, is shares outstanding. They do a lot of share buybacks, a lot of returning excess cash to shareholders. 846 in 2013, 688 in 2022. So lots to see, lots to love about this company. ROIC very consistently above 10%. We do see it straddle around 14 to 17% year on year. So I do like seeing consistency, especially when they are positive metrics. Operating margin, again, what's nice to see, not only the consistent nice rates, but also the fact that these percentages are increasing year on year for the large part. So it is positive to see they are looking to operate more efficiently to that income statement. Free cash flow margin as well, maybe a bit more inconsistent, but we do see the last 3 years as well as 2023 in the 20s as a very positive sign. Finally, net debt to EBITDA, remember it signals balance sheet strength and dividend safety. 1.74, which is well below the 3, the maximum we look for in this industry. 2023 is expected to increase slightly higher, maybe something to keep an eye on, but it is still well below that 3 that would signal any cause for concern. So let's jump into the valuation. As always, if you enjoy the content, smash that like button. If you want to subscribe, hit that bell button so you are continually notified of these videos as they drop. So the intrinsic value is coming to $132 with a current price at around $125. So for CNI, when we put in the 5% margin of safety, we can see it is acceptable at that price. So right now, you are really only getting a 5% margin of safety. For me, given this is one that I hold, it isn't one that I will be looking to buy until I see at least around 15 to 20% margin of safety. So personally, for me, this is a hold at the moment. But I would be interested as we go along these videos, the episode, let me know your thoughts for each one, whether you are looking to buy, hold, or sell. In terms of Wall Street, well, what do they see? Well, they, as we can see here, believe there is around a 5% upside. So in conclusion, for CNI, we see around a 5% margin of safety with around 5% upside per Wall Street analysts. We then move on to Bill Gates' third largest position, which is waste management. Now, this is one that is up around 13% year to date. Again, lagging behind the S&P, but also at the 52-week high. It does offer a yield of around 1.58%. Now, if you've been holding this, you would be up around 303% over the last 10 years. And when we jump into the metrics, we see the dividend score at 74. It is safe. Market cap 72 billion, a large cap company. Now, in terms of recessionary metrics, well, they increased the dividend during the last recession, average growth during this period, and they also outperformed the recession of the S&P 500's performance, negative 40 versus negative 55. Dividend growth, nice to see, above inflation increase just this month, 9% over the last 5 years on average, and over the last 20 years we see 32%. So it would be nice over the next few years to start to see more in line with the last 20 years, at least in the double digits, but overall still fairly positive. They have been increasing those dividends for the last 19 years or more as well. In terms of dividend yield theory, well, you could argue reasonable valuation with the current yield not too far off the 5-year average. Likewise, the forward PE showing us the same, 27.2 versus 26.7. Now, when we take a look at the sector PE, it is significantly higher than the industrials of 19.8. Jumping into the payout ratio then, when we look at the free cash flow, we do see for the large part it is below 60%, although do note 2023 it is expected to come in at 67%. Still not too bad, and we should be expecting some nice, at a bare minimum, high single-digit increases to the dividend. Free cash flow per share, inconsistent, but it still does increase over the last 10 years, nearly double the beginning number, 253 to 472, although note in 2023 it is expected to come down to $4.11. Sales growth, fairly inconsistent. We see a few years where it didn't have the greatest period, 2013 to 2015. It wasn't even keeping up with inflation, and then also decreased in 2015. But then we do see the 2016 to 2019 period where it pretty much kept in line with inflation before dropping in 2020 and then picking up double digits. 2023 is expected to be in line roughly with inflation, and numerically we do see this 14 billion in 2013, 20 billion in 2022. Now, Waste Management also do share buybacks. As we can see, they have bought back a considerable number of shares over the last 10 years, from 470 million in 2013 to 415 in 2022. ROIC, again, consistently above 10%. The last few years in the mid-teens, as we see 13-14%. 2023 expected 15%. Now, operating margin, free cash flow margin, happy to report it is above those minimums we look for on both accounts. So this is a fairly popular, not only just a popular company, but also one that is consistently hitting some strong margins on both the operating and free cash flow margin front. Net debt to EBITDA, maybe one just to keep an eye on, with the last few years at 2.66. 2023 it is expected to come down to 2.6, but possibly one over the longer time to keep an eye on to ensure it is below that 3 target. Now, when we look at the valuation model, and as always, if you do want to grab a copy of the valuation model to run your own companies through to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. So we start off with Waste Management at a 5%. As we can see, it is pretty much only trading at a 5% margin of safety. So for the large majority of you, including myself, this isn't one that does look to be a buy right now at this margin of safety. Perhaps if you were looking at a 20% margin of safety, it would be acceptable around $150. So currently a 5% margin of safety, and in terms of Wall Street, well, they forecast the price over the next 12 months to be roughly in line with our intrinsic value. They also see around a 5% upside. So in conclusion, for Waste Management, we see around a 5% margin of safety with around 5% upside. We then move on to the fourth company, which is Caterpillar in the construction and machinery industry. Year to date, pretty much in line with the S&P, up 24%, again towards the 52-week high with a yield around 1.75%. If you've been holding this over the last 10 years, well, you would be up around 232%. We can see dividend safety score very safe at 93, 151 billion market cap. It is a mega cap company. We do see it's increased the dividend during the last recession, although do note it had below average growth during this period. You could put that down to cyclicality. Recession return, it also severely underperformed with a negative 70% return. Dividend growth fairly consistent, 8% this year, which is very nice, above that 4% I advocate. Last 5 years, 9%, and on average over the last 20 years, double digits at 10%. So that is nice to see. It is also a dividend aristocrat, as we mentioned earlier. And when we take a look at dividend yield theory, you can argue overvaluation. The yield is below the 5-year average, although on the forward PE, there is a sense of reasonable valuation, with the forward PE at 14 versus the 5-year average of 15. And as mentioned before, the industrial sector PE is 19.4, whereas with Caterpillar in this case, it is below that. Now, taking a look at their payout ratio, we do see the free cash flow at 48% this year. 2023 expected to go even lower, so we could be seeing a double-digit increase next summer to the dividend. But again, do note this is slightly higher than the industrial average for 40%. So again, it might be something just to keep an eye on, but personally for me, 60% or lower is something that I am happy with in any of the companies. Free cash flow per share, you can put this down to the cyclicality of the industry. It isn't consistently increasing. In fact, we see it go from $8.90 in 2013 to $4.64 in 2016 before picking back up. Although do note 2023 is expected to be an incredibly strong year with $16.90 noted. Sales growth, again, cyclicality, we see 4 years of negative growth followed by 2 years of double-digit increases, and then so on and so on, the cycle continues. So you do want to be looking to buy companies when they are out of favor, out of their cycle, picking them up at a much cheaper valuation. Total sales then, as we see, 56 billion in 2013, 59 billion, and we can put that down to cyclicality. Shares outstanding, nice to note, they do share buybacks, 659 in 2013, 530 in 2022. ROIC, inconsistent, not always around that 10%, although the last 2 years have been very strong. 2023 at 24%, very, very strong and an all-time high, or at least over the last 10 years. Now, when we look at the margins, operating margin, if we start with that, it does look like they do struggle consistently to have those margins at least 15% for the heavy equipment makers industry, although the last 2 years as well as 2023 is expected to be an improvement from this, but it is something I would keep an eye on if you were an investor or potential investor. Free cash flow margin above the 5%, 13 in 2023, so that is fairly positive. Net debt to EBITDA, 0.96 in 2022, below that 2.5. 2023 expected to be even lower, so it does have a strong balance sheet as well as a very nice dividend safety score. So let's jump into the valuation model. Don't forget, smash that like button if you're enjoying the content. Hit the subscribe and bell button if you want to be continually notified of these videos as they drop. Intrinsic value, $295. Well, we can see right now it is pretty much trading at its intrinsic value based on our estimates and judgments. So you are really not getting any margin of safety. What do Wall Street say? Well, they believe, in fact, the share price to go down over the next 12 months, as we can see here, around 5%. So this is an interesting one in today's episode of Caterpillar based on our estimates and judgments and looking at Wall Street. We believe it has no margin of safety currently, and Wall Street believe the share price to drop by 5% over the next 12 months. Let me know your thoughts in the comments. Do you agree with this analysis, both from our side as well as Wall Street? We then move on to the fifth company, which is Deere Company, in a similar industry. It is down 6% year to date. It is trading towards the midpoint of the 52-week range with a 1.47% yield. Now, if this is one you've been holding over the last 10 years, you would be up around 343%, a very strong performance. It does have a very safe dividend score at 83, a 112 billion market cap, a mega cap company. And when we focus on those recessionary metrics, well, they maintained the dividend during the last recession, below average growth, but also underperformed the S&P with a negative 65% return. Last full year, double-digit increase at 16%. We'd love to see that. Last 5 years, double digits, 14%. Last 20 years, double digits, 13%. Very nice, a very strong dividend growth company. But do note they've only been increasing those dividends for the last 3 years, as we see a period here from 2019 to 2020 where that dividend was maintained. Now let's look at dividend yield theory, where we can see here a sign of undervaluation. Current yield above the 5-year average, as well as the forward PE below, so something just to bear in mind. And we can see the PE is below the sector PE of 19.8. So how does the free cash flow payout look like for Deere Company? Let's take a look. So we can see 2023 it came to 36%. 2022, now this is why we always say ignore earnings, it is susceptible to manipulation by management through accounting. If you were to look at 2022 at 18%, you would be happy with yourself. 2022 on the free cash flow shows us that they were paying out more in dividends than they generated in free cash flow in 2022. So again, something to keep an eye on, but this was 2022 and not 2023. Now, free cash flow per share, very inconsistent. We see a few years of positive before a few years of negative and then back to being positive, but we do see dips and then it does pick up. So again, this does suffer from cyclicality, so something to keep in mind. And this is better shown here with the sales growth, similar to the previous company Caterpillar. A few years of negative growth followed by positive and so on. And when we look at the total sales, it's gone from 36 billion to 61 billion in 2023. Likewise, they do share buybacks similar to all the companies we've analysed, 366 million in 2014, 294 in 2023. ROIC, it's nice to note the last 3 years it has been above 10%, but there was quite a period, in fact 6 years, where it was below that, but the fact it has picked up is a positive sign. Operating margin, it is one they have tended to struggle with over the longer term, but again, something to note, over the last 3 years they have picked this up. But again, if it was me, this is one that I would keep my eye on just to ensure it doesn't drop back down below 15%. Free cash flow margin, the last 4 years haven't been too bad. We do see that drop in 2022, but the period before then, again, not the greatest. So do note, if you are looking to invest in any of these companies, that there are some things you do just need to bear in mind for the future. Net debt to EBITDA then finally 1.04 in 2023, the next 12 months 1.28. So this is a company that has a strong balance sheet and, as we saw, a very safe dividend score. So let's jump into the analysis, and as always, if you do want to grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, do click on that pinned comment below and you can grab a copy. So intrinsic value coming to $461 with our margin of safety at 10%. We can see here the acceptable buy price at around $415, so you are getting at least a 10% margin of safety. At 15%, it is slightly lower, so you could argue for DE. In today's episode, you are getting between 10 to 15% X margin of safety. What do Wall Street say? Well, they see around 10% upside over the next 12 months. So in conclusion, for Deere Company, we see around a 10 to 15% margin of safety, with Wall Street expecting around 10% upside. As always, if you've enjoyed the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, click on that pinned comment below so you can get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. As always, have a great day and catch you all on the next episode. Take care.